Let's be honest about something. The moment that Supreme Court ruling hit the wires, you could almost hear the champagne corks popping on Wall Street. Finally, someone stopped the madman. Finally, the adults were back in the room. The S&P 500 jumped, traders exhaled, and for about 48 glorious hours, the financial media told us the worst was over. And here we are now. Take a good look around. The Dow just opened 600 points in the red. Software stocks are getting absolutely obliterated. Oracle down 6%, SAP down 4%, Bitcoin sitting around 66,000 and sliding. And somewhere in the White House, Donald Trump is furiously typing tweets about how he's going to make every single country that dared to celebrate that court ruling pay a very, very heavy price. So much for the adults being back in the room. Because here's the thing that almost nobody in mainstream financial media wanted to say out loud when that ruling dropped. A Supreme Court decision that strips the president of his tariff powers doesn't end the uncertainty. It creates an entirely new kind of uncertainty, a more dangerous kind. The old uncertainty was at least predictable in its unpredictability. You knew Trump would threaten, markets would wobble, negotiations would begin, some deal would be hashed out, and things would calm down for a few weeks before the next tweet storm. It was exhausting. Yes, irrational. Absolutely. But it had a rhythm. You could almost trade around it if you were brave enough. Now there is no rhythm. Now there is just a genuinely furious president with access to the most powerful economic levers on the planet, a bruised ego, and the unshakable conviction that he alone understands what America needs. That combination, ladies and gentlemen, is not a buying opportunity. That is a 5-alarm fire. Before we go any further, write in the comments right now, do you think Trump's tariffs are a genuine economic strategy, or is this just pure ego and political theater? Tell us what you think, because this question matters more than most people realize. Trump's relationship with tariffs goes back decades, and this is something worth understanding properly rather than dismissing as the ramblings of an unstable politician. In the 1980s, when Japan was eating America's lunch in electronics and automobiles, Trump was already taking out full-page ads in the New York Times, arguing that the United States was being ripped off by its trading partners and that tariffs were the only way to restore the balance. That was 40 years ago. This is not a position he arrived at last Tuesday after watching a Fox News segment. This is a deeply held, almost religious conviction that trade deficits represent a form of national humiliation and that tariffs are the instrument of national redemption. The problem is that conviction is economically illiterate in ways that cause real, measurable, documented harm to the very people it claims to protect. Here is the fundamental misunderstanding at the heart of Trumpian tariff logic. A trade deficit does not mean that foreign countries are stealing from you. It means that your citizens are buying more things than you are selling. And why are American citizens buying more than they're selling? Because for decades, the central question in American household economics has not been what can I afford, but how can I pay for it? Credit cards, second mortgages, buy, now pay later. The American consumer has been living beyond their means for a generation, and the rest of the world has been happy to supply the goods in exchange for dollars. Dollars that the United States prints itself. That is the real trade. Other countries send real, tangible, valuable goods. America sends paper. Beautifully printed paper, yes. Paper backed by the full faith and credit of the world's largest economy. Yes, but paper nonetheless. To call that arrangement exploitation is to fundamentally misunderstand who is actually getting the better deal. And yet, here we are, with the highest average tariff rate since the 1930s, a level not seen since the era of Smoot-Hawley, which, for those who need a quick history lesson, helped turn a stock market crash into the Great Depression. The parallels are not perfect, they never are, but they are uncomfortable enough to warrant serious attention rather than dismissal. The industrial sector in the United States, which tariffs are supposedly designed to revive, is not booming. Job losses in manufacturing have continued. The trade deficit has not meaningfully improved. The goals that justified the pain have not been achieved. And now, rather than acknowledging this failure and recalibrating, the response is to double down, to triple down, to announce that the Supreme Court ruling has actually given him the freedom to impose even bigger, even harsher tariffs than before. How you get from a court ruling that says your tariffs were unconstitutional to the conclusion that you now have more tariff power than ever before is a logic that requires a very particular relationship with reality. What markets hate more than bad news is uncertainty. Bad news can be priced in, uncertainty cannot. When Trump held up those tariff boards in April of last year, remember those cardboard signs with the numbers written on them, like some kind of international trade show and tell? Markets panicked. Then negotiations began. Then there was a partial deal. Then relative calm. The system, dysfunctional as it was, had a beginning, a middle, and something resembling an end. The Supreme Court ruling has blown up that structure entirely. Now, the EU, which had negotiated something that at least resembled a workable arrangement, finds itself back at square one. The trade deal that was never quite ratified by the European Parliament is now functionally dead, and Trump's message to any country that thinks the court ruling gives them leverage is stark and direct. I will punish you harder than anyone else. So the EU faces a situation where the deal they thought they had is gone. The court ruling they hoped would help them has made things worse, and the man on the other side of the negotiating table is, by any honest assessment, behaving like an extremely irritable child who has just been told he cannot have dessert. Meanwhile, the markets have discovered a second crisis running in parallel to the tariff chaos, and this one, in some ways, is even more structurally troubling. The great AI euphoria that carried tech stocks to extraordinary heights over the past 2 years is beginning, slowly but very visibly, to crack. And the crack is not in the places most people expected. It is not Nvidia falling apart. Nvidia is actually holding up remarkably well going into its Wednesday earnings report, and one analyst upgrade after another keeps the stock supported. No, the crack is in the software sector, in Oracle, in SAP, in the companies that built entire business models on the assumption that enterprises would keep paying premium prices for their products, regardless of what else happened in the technology landscape. The IGV software, ETF, which started the year comfortably above 100, has now broken below 77. That is not a correction. That is a collapse in slow motion. The question the market is now being forced to confront is one that sounds almost too simple to be serious. Do we actually need these companies anymore? If an AI system can do in 30 seconds what enterprise software required an entire licensed platform and a team of consultants to accomplish, then what exactly are we paying for? This is the question that is tearing through the software sector like a wrecking ball. And it is not going to be answered by one good earnings report or one reassuring analyst note. It is a structural question about the future of an entire industry, and structural questions do not get resolved in a single trading session. Now, here is the deeper problem, and this is the one that the really smart money is starting to think about very carefully. The hyperscalers, Microsoft, Amazon, Google, the giants who have been pouring hundreds of billions of dollars into AI infrastructure, have made a bet of historic proportions. Data centers everywhere, chips by the millions, electricity consumption that is starting to strain national power grids, and the return on that investment still essentially theoretical. The revenue models are still being figured out. The killer applications that justify the capital expenditure are still being identified. You have the infrastructure of a gold rush without anyone actually finding gold yet. What you do have is a lot of very expensive shovels, and those shovels are getting more expensive by the day. Because here is a technical problem that barely makes it into mainstream coverage, but is absolutely devastating in its implications. A significant portion of the chips that these hyperscalers bought and stockpiled over the past 2 years are already obsolete. The pace of AI development has been so ferocious that hardware bought 18 months ago simply cannot keep up with the current computational demands of modern AI training. The cost of running serious AI inference on outdated chips is so prohibitive that you might as well throw those chips in the bin. The giants have not written this down yet. It has not shown up in their balance sheets in any honest way. But it is there, a hidden impairment, sitting inside the most valuable companies in the world, waiting to be recognized. And then there is the memory problem. The newer, more powerful chips that actually can handle current AI workloads require exponentially more high-bandwidth memory to function properly. The manufacturers of that memory cannot produce it fast enough. Samsung has already raised its prices by 30%. Others will follow. So you want to build a modern, competitive data center. Congratulations, your cost structure just became significantly more brutal before you have sold a single dollar of AI services. The economics of this industry are being squeezed from every direction simultaneously. Obsolete existing hardware, insufficient new hardware supply, skyrocketing component costs, and energy infrastructure that in many places simply does not exist at the scale required. Write in the comments, do you think the AI bubble is more dangerous than the dot-com bubble of 2001? Have you already seen it affecting jobs in your industry? We want to know what you're seeing on the ground. The dot-com comparison is worth dwelling on for a moment because it is not just a rhetorical flourish, it is a structurally accurate description of what appears to be happening. In the late 1990s, the logic was simple. The internet is going to change everything. Therefore, companies connected to the internet are worth almost infinite amounts of money. The logic was not entirely wrong. The internet did change everything, but the valuations were insane. The business models were non-existent, and when reality came calling, it came hard and fast and without mercy. The Nasdaq fell 78% from peak to trough. Companies that had been worth billions became worth nothing, and the recovery took years. Now the logic is AI is going to change everything, therefore companies connected to AI are worth almost infinite amounts of money. Sound familiar? The logic may not be entirely wrong. AI may indeed change everything, but the valuations are extraordinary. The monetization is unclear, and the infrastructure costs are spiraling in ways that were not in anyone's original spreadsheet. Sam Altman, the chief executive of OpenAI, made a rather extraordinary attempt at public relations this week when asked about the sheer quantity of water that AI data centers consume for cooling. His response was essentially, have you considered how much water a human being uses over the course of a lifetime? Setting aside the philosophical peculiarity of comparing a data center to a human being, what was actually remarkable about that statement was what it revealed. The people running the most powerful AI companies in the world are now in full defensive mode about their resource consumption. When your best argument for your environmental footprint is a whataboutism involving childhood development, you are no longer winning the public argument, you are managing a crisis. And while all of this is unfolding in the technology sector, the commodity markets are quietly telling a different story. Gold is up, driven by a combination of tariff uncertainty and renewed geopolitical tension in the Middle East, where the signals coming out of Saudi Arabia regarding a fundamental change in the Iranian political situation are being taken very seriously indeed. The Americans have evacuated non-essential personnel from Beirut. That is not a routine administrative decision. That is a specific move with a specific history. The last time it happened, something significant followed shortly afterward. Whether that something follows again this time remains to be seen, but markets are not dismissing the signal. Silver is also up, and the reasons there are more specific. Mexico, which is the world's largest silver exporter by a considerable margin, is in a state of genuine security crisis, with cartel activity at levels that have prompted serious conversations in Washington about deploying private military contractors to address what the Mexican government has candidly admitted it cannot handle through conventional law enforcement. When your largest silver supplier is potentially heading toward a period of significant internal instability, silver prices respond accordingly. That is not speculation. That is supply chain logic in its most basic form. Geopolitically, there are several other moving parts worth tracking. Ukraine has successfully struck the Druzhba pipeline, which is a painful development for Hungary and Slovakia, who remain dependent on that route for their energy supply. Russia's economy, meanwhile, is showing the signs of a system under sustained and mounting pressure. Oil is being sold at historically large discounts on international markets. Gold reserves are being liquidated to cover fiscal gaps. These are not the moves of an economy operating from a position of strength. These are the moves of an economy that needs cash and is running low on elegant options. How that pressure ultimately translates into battlefield or negotiating decisions is the question that everyone, from Washington to Brussels, is trying to answer right now. Back to Wall Street, because the market dynamics in this moment are genuinely unusual in ways that deserve more attention than they are getting. On the surface, the major indexes look relatively contained. The S&P 500 is not in freefall. The Nasdaq 100 has not crashed. But that surface-level stability is concealing something extraordinary underneath. Individual stock volatility at levels that exceed anything seen during the 2008 financial crisis or the COVID crash of 2020. Think about that for a moment. More volatile than Lehman Brothers collapsing, more volatile than the world economy shutting down for a global pandemic. The individual stock moves happening right now beneath the relatively calm surface of the index are historically extreme. The reason the index is not showing it is rotation. Money is fleeing tech and software and financials and moving into consumer staples, healthcare and energy. Defensive positioning at scale. The index stays stable because the outflow from one sector is matched by inflow to another. But underneath, it is chaos. It is the investment equivalent of a building whose facade looks intact, but whose internal structure is actively failing. And by the way, where in the world are you watching this from right now? Drop your city and country in the comments. We want to see how far this conversation is reaching. The financial sector, which rarely gets enough attention in these discussions, is also deeply implicated in everything happening with AI. A significant proportion of the private credit market, the complex, often opaque world of direct lending to tech and software companies, is now sitting on loans to businesses whose fundamental viability is being called into question by the AI disruption that everyone was supposed to be celebrating. When your loan book is full of enterprise software companies, and those enterprise software companies are facing an existential question about their relevance, your loan book has a problem. This is not a hypothetical. Blue Owl, one of the major players in private credit to the tech sector, fell 4% alongside the software stocks this week. The market is connecting dots that the official risk assessments have not yet caught up to. In Germany, the numbers are not kind. Corporate tax receipts for January 2026 came in 79% below the same month last year. 79% in a single month. That is not a rounding error. That is a catastrophic collapse in the tax base of what is supposed to be Europe's largest economy, and the political response being prepared involves a wealth tax whose primary practical effect will be to accelerate the departure of the people who actually generate the tax revenue in the first place. The economics of taxing your way out of a structural competitiveness problem have been tested many times in many countries. They have never worked. They will not work here either. Novo Nordisk, meanwhile, is continuing its painful descent after its latest drug failed to demonstrate meaningful superiority over Eli Lilly's competing product. This is what happens when a company builds its entire valuation on a single narrative, and that narrative hits a wall. The stock has been in a slow-motion collapse for months now. The people who got out early look smart. The people still holding look like they are waiting for a miracle. The Bitcoin situation deserves a brief mention because it illustrates something important about market psychology right now. The world's largest Bitcoin miner just sold its entire position, not because of a regulatory change or a strategic pivot, because the cost of mining a single Bitcoin now significantly exceeds the price at which that Bitcoin can be sold. When the economics of an asset make its production structurally unprofitable, you're in a very specific kind of trouble. The bullish argument is that reduced mining means reduced supply coming to market, which should support the price. The bearish argument is that the institutional enthusiasm that pushed Bitcoin above $100,000 was built on assumptions about monetary policy and risk appetite that are now being revised in real time. Both arguments have merit. Neither is a certainty. Bitcoin around 66,000 is still dramatically higher than where it was 2 years ago. But the trajectory has shifted and the narrative has changed. So, where does all of this leave us? We have a tariff situation that has gone from complicated to genuinely chaotic following a court ruling that everyone initially celebrated. We have an AI investment story that is confronting the hardest of all questions. What is this actually worth? And when does the return on investment arrive? We have geopolitical pressure from the Middle East, from Ukraine, from Mexico, building simultaneously in ways that do not typically resolve quickly or quietly. We have commodity markets quietly pricing in the rising probability that something significant disrupts global supply chains in the next few months. And we have a Wall Street that is beneath the surface of the major indexes, more volatile than at any point in living memory. The investors who are navigating this moment well are doing something very simple. They're not asking which sector is going to go up next week. They're asking which assets retain their value when trust in the system itself comes under pressure. The answer to that question looks roughly the same today as it has looked in every period of genuine systemic stress throughout recorded economic history. And it is not enterprise software, it is not AI hyperscalers with unresolved monetization questions, it is not crypto mining operations that cannot cover their costs. It is real things, scarce things, things that exist independently of whether a particular government makes good decisions or a particular technology delivers on its promises. NVIDIA reports on Wednesday. The numbers will probably be impressive. They may even be spectacular. And the market's reaction to those numbers will tell us something very important, not about NVIDIA, but about the psychological state of investors in this moment. If spectacular numbers from the best-positioned AI company in the world cannot move markets higher in a meaningful way, that is the signal. That is the moment when even the most optimistic participants have to concede that the AI trade has passed from a growth story to a reckoning. The Klondike Gold Rush minted a handful of billionaires and broke thousands of ordinary dreamers. The men who got rich reliably were the ones selling the shovels. Right now, NVIDIA is selling the shovels. But when the men buying the shovels start running out of money, even the shovel seller eventually feels it. The uncertainty is the story. The uncertainty is the market. And until someone in Washington, in Silicon Valley, somewhere, provides an honest answer to the questions that the market is actually asking, the uncertainty is not going away. Plan accordingly.